what really happened to my mind is one of the that particularly counter to a lot of the American arguments on the global imbalance of China causing the problem because of their exchange rate being too low. My counter to that argument is that, look, suppose the 2 points actually. One, that if that given that the euro has appreciated with respect to the dollar, it has appreciated also much more with respect to the renminbi. So that if the renminbi is undervalued with respect to the dollar, undervalued with respect to the dollar, then it's even more undervalued with respect to the euro. Then how come Europe does not have a huge current account deficit with China? And it does not. And therefore, to my mind, that suppose Chinese did revalue substantially, what would happen is that the other exporters will replace China as suppliers to the United States market. To my mind, is the domestic macro imbalance in the United States, both the fiscal deficits, budget deficits, that is the government is saving, plus of course very low private sector saving, very low private sector savings. So on a macro basis, a basic macro, if you have savings, if S minus I is negative, you'll have a large current account deficit, and therefore you have an imbalance. Obviously, there is some that it is the case that the Chinese exchange rate is undervalued, and it will make an effect to the Chinese surplus if the Chinese revalued more. But it seems to me it won't make much difference in the United States, because if Chinese goods become more expensive, when you go to Walmart, you'll buy Vietnamese goods or Indian goods or Filipino goods or Indonesian goods or Mauritian goods or African, wherever it is. Yes.
Isn't that already happening as well?
It is happening now, yeah. It is happening now. So I've always found this argument disingenuous from the Americans' part. It's correct that the Chinese exchange is undervalued, but it's really much more a domestic imbalance, which is then showing itself out in the external imbalance in both countries. That if the Chinese domestic imbalance was corrected, that is their consumption went up relative to investment, then they would have less of a surplus. Same thing with the US. But the US problem won't be solved by the Chinese action. The US problem will only be solved by the US actions. Chinese problems will be solved by the Chinese actions. All it does is you substitute other countries if you don't. So you have high interest consumption, you have cheap goods coming from other countries, very efficient credit market here, low interest rates, ninja loans, and if you have ninja loans, you have everyone buying a new house. When you buy a new house, what do? You fill it up with goods. Right? You go off to IKEA or you go off to Walmart. You go off and fill up those huge carts and bring them home. So that's the effect. The ninja loans has an effect on consumption as well overall. And of course, US borrowed like mad. It's very interesting. The US net liabilities to the rest of the world was less than 6% of its GDP in 1970. 2006 was about 20%. So that's the kind of increase. Now everyone has increased incidentally. It's not just US because of greater cross-border flows in general, but the US has increased faster than others. So that's one issue to do. The one argument on what caused monetary excess. Second was I go much more on the monetary excess side. I go less on the global imbalances side, although there is an element of that obviously, as I mentioned. Then of course there's a monetary interaction with the subprime problem. That which I talked about that earlier, excessively low interest rates, so your perception of low risk from all concerned, including households. That if I that if I can buy a $500,000 house, and if I'm borrowing say $500,000, and if I have a 10% interest rates, then I'm paying $50,000 a year. I mean, very roughly speaking. If I have 2% interest rates, I'm paying $10,000 a year. So obviously, very much more likely to get into higher consumption with your perception of your risk, especially with prices going up all the time. So you have excessive risk taking. You increase in housing prices on a continuous basis for many years. You have low delinquency. From the lender's point of view, it's it's low risk. And it's a low risk from the borrower's point of view as well. So there was a perception that housing prices would keep increasing. And the point I made earlier was that's natural for the micro player's point of view. There's nothing wrong, it's totally rational. But regulators should have known better. And I can tell you, even though this may sound like self-congratulation, but in 2006-07, we don't have in India as good housing price data because we don't have a systematic method of collecting housing prices. Also, our markets are much more imperfect, they're very segmented markets and so on. But whatever information we had, we felt from the Reserve Bank that housing price was going up, real estate price going up too fast. We also felt that lending to real estate is going up too fast. Again, there's a problem there that when you have a developing country and if urbanization taking place, you would expect real estate and housing lending to go up faster than other things because people are urbanizing, much more investment taking place, so that's normal. And you don't really know what is the correct, what ought to be the normal rate of increase in housing lending. But we acted in terms of raising the risk weight, the portfolios of banks on housing and real estate lending. Now, I've asked the question of my colleagues, and it had an effect that it slowed down. What I don't know is if it slowed down because we made it more expensive for the banks. I'm not sure how much effect there was in the actual bottom line, but I think it has much more an announcement effect that the central bank and the monetary authority and the regulator are telling you that there's a problem here. You're going to have delinquencies. Slow down, both to the borrowers as well as to the lenders. So there's an announcement effect also, and it's very difficult to actually figure out which is more important, the actual impact on the bottom line through doing some measures, or you can have a loan to value ratio limit. There are all kinds of things you can do if you think. And as I said, in developed markets it's easier because you have much more information, and in developing markets it's more difficult because you have less information.
How do you measure the effect of how much that curbs entrepreneurial and consumer spending that fuels investment?
Difficult. Post facto, we can observe that the growth in lending slowed down. Now, you'll have to do a more complex econometric exercise to take account anything else that may have changed. Right? That it could be that prices have gone up so much that households can't afford, that the price income ratio may have gone up too much. And if the house, so there could be a slowdown just because of that. So you can't tell very easily. But so it's a very good question. And when we were taking these measures, some of the people in the market would ask us, "How do you know? You're increasing the risk weight from 50% to 100% to 125%. Why not 150? Why not 200?" No answer.
I mean, especially because the data is poor.
Yeah, data are poor, but also a lot of these thing that you'll hear from me through the course is that my personal view is that a lot of these things have to be judgmental, and you can be wrong, but it ought to be that as regulators and policymakers, you ought to be willing to make judgmental risks, and also willing to get fired. And in my view, you're being that if you get in the profession of central banking or financial regulation, that's your job, and you're being paid to make judgments. If you don't make judgments, you can hire a computer, and put the computer there. Ken Rogoff, by the way, has said that in some articles. There is, but it's not an easy issue, because there's the opposite side. You know, why should the country trust 5 people's judgment or 1 person's judgment? You know, he's not God or she's not God. So those, I mean, they're both different relevant views. Then there was inadequate, of course, financial regulation supervision. The point that I made, that you have another figure here from John Taylor's article, that the counterfactual increased number of units should have been this bottom line, not the kind of increase that took place. That's a model simulation, and again, any model is good as what you put into the model. But the point basically is that because of inadequate financial regulation supervision, there was a huge growth in lending, increase in leverage, ninja loans, and so on. And when you did start increasing interest rates, then there was a very quick impact on housing prices, and that's when post subprime stuff started suddenly, because it gone off too far. You started increasing interest rates, then the people who had borrowed to the hilt started defaulting, and then the whole house of cards fell down. This is similar to the numbers that Bob Schiller had. This is in Reinhardt and Rogoff. The price increase in 1986 to 2006 was totally incomparable to anything seen before. There was a 92% real price increase in real estate in the United States between 86 2006, compared to something like 27% cumulative over the previous 90 years, from 1896 to 1986. And what surprises me is, with all these data available in the United States, which we don't have, right, which other countries don't have, how come the regulators did not see this? And you know, you can, through regulation, you can have limits of loan to value ratio. They have that in Germany. You can start increasing risk. There are all different measures you can take, both through announcement effect plus actual effect through regulation.